we're now going to have a panel discussion. We're going to discuss achieving returns in a high interest rate environment, which is a very timely topic. And we're going to look at how debt restructuring and asset management became critical to portfolio returns. So I'd like to invite Stephen Inglis, CEO of London and Scottish Property Investment Management, the manager to Regional REIT, to the stage. Jeff O'Dwyer, fund manager of Schroders European REIT, and Matthew Howard, fund manager of CT Property Trust. I'll stay down. In fact, I'll go. Steve, do you want to kick us off? Should we talk about the cost of finance and where rates and inflation have gone and what happens?
Sure. I mean, we obviously saw, as both speakers have commented on, the largest quarterly fall ever in terms of valuations, which was obviously a fear or scare. Thank you. A fear or scare into the marketplace. I mean, we got to look at it in context. What did happen actually last year was that the valuers decided to down value based on interest rate movements. And we all accept higher interest rates had an impact on values. I think what I would contend is that correlation is not a direct correlation, nor is it instant. Normally what happens in a marketplace is you see valuation corrections in terms of the economic environment, i.e. interest rate rises. The market then takes some time to digest what that means to them. They make decisions on what returns they're prepared to accept, and values change in terms of transactional values, which drives valuation. That's not what happened last year, and clearly we have a situation that I think is slightly false in terms of the valuation correction. Nobody actually knows whether that valuation correction is accurate or not, but certainly the evidence in the last few months is showing that the yields are probably better, values are a better level than they were December last year. So the market is beginning to self-correct, and that's the way it should be.
And you're a believer that refinancing is going to help bring some of these things to the fore?
Yeah, I mean, we have seen obviously another increase in interest rates, and the impact of that is yet to be seen. It doesn't seem to be impacting the transactional market at this point. Perhaps that overcorrection helped in December. But yeah, we are seeing a correction to all markets. Industrial is probably first to recover, but it'll take some time to flow through.
So I'd like to ask the panel how we go about achieving higher returns in this environment where money costs more and cost pressures are going up. Jeff, would you like to take that?
Yeah, happy to. I mean, one of the things that we're sort of actively working on is that sort of operational element that you touched on, Ollie, in your piece, but being and sort of working a lot closer with our tenants and trying to drive returns that way. So we're not, as a house at Schroders, we're not a big user of debt. But we are, and sort of pride ourselves on being very good asset managers and with that operational flair and hospitality mindset. And this is something that we've learned from the hotel side of the business. So the COVID has really brought us a lot closer to our tenants and understanding what their sort of difficulties are and sort of some of their business problems. So working with them and trying to understand and bring down not only just sort of their operating costs, but actually how can we work with them to deal with some of their other business issues. So I think as an owner of real estate, it's not just about collecting rent now, it's about actually understanding your tenants' businesses and really holding their hand when there are difficulties. So that's what we're seeing and looking at and trying to do, and sort of how we can, I guess, work with our tenants, keep the tenants. I think that's quite key going forward. So not relying on sort of using sort of cheap debt, which is no longer exists, but actually keeping your tenants and then working and managing those assets to create value. Improving sustainability, I think that's a key part as well. I think we're still early signs of that, but we're starting to see occupiers really starting to think about that requirement to be more sustainable, and therefore working with an owner that can help them achieve that. And certainly at Schroders, that's how we pivoted over the last few years to being much more sustainable led.
Hotels are clearly quite operationally intensive. Would you expand a bit on the learnings from that sector and maybe what it's done to lease lengths and
yeah, I mean, I don't run that side of the business, but what I can sort of say and what we're trying to lever off in terms of not only across sort of how we operate offices, but say retail and some of the industrial, but really trying to manage that sort of the bottom line as well. So sort of working through that operating costs. Obviously, the hotels went through a pretty difficult period in terms of trying to keep occupancy, and I guess the whole tourism side of things just stopped. So I had to really look about how they can reduce the operating costs and the fixed costs that go with that. So there's elements of that we're tapping into. We work very closely with the hotels team. That's now starting to improve massively, and I think that's probably a sector that we've got a lot more conviction on going forward. And think about conviction across the different sectors. There's not actually that many that you can have at the moment. There's a lot of, I guess, headwinds that we're all trying to price, but certainly we think hotels going forward, as things have now opened up and people are now traveling and businesses opening up as well. We see a lot more growth there. But I think that the operational side, we take on the risk there. We've got a team in-house that they can operate these assets. And I think that's something that is becoming more and more clear around offices, around retail and industrial as well. That you've got to know how to operate these things.
Absolutely right. I guess we can't talk about rising rates without looking at rising inflation and rising costs for asset managers. Who would like to take that? Matthew, would you like to express a view on that?
Yes, certainly. I think really what there's you touched upon it in your keynote speech, Oliver, about noise at the moment and the capital value movements that we've seen over the last, not just year, but the last kind of 4 to 5 years, which have moved around and certainly not been in line with kind of long-term trends. So I think what that distracts from is the fundamental asset management point, and that's how you gain accretive returns from property, which is, yes, you've got the top-down thematic investing, which is obviously key, but also it's a good old school bottom-up investing as well, understanding the markets and shrewd asset management. Costs have obviously been one of those challenges. If you look at service charge budgets, for example, broadly speaking, they've inflated, and I'm oversimplifying it, but 20% or so in the last couple of years. Construction costs, speaking to some of our main consultants, again, oddly, or not oddly really, during COVID, construction costs were flat because we had contractors who were buying jobs because they didn't have much of a pipeline, so they kept the lights on. But since then, we've had construction cost inflation of about 20%. Now, that's a challenge to everyone, obviously. But when you're working in the relatively core, relatively prime end of the market in prime type of locations, then feasibility-wise, you're more likely to be able to absorb those because obviously you're working at the higher end of the market, and that sort of coincides as well with the trend. We speak about the flight to quality, certainly on the offices side, which is a whole other point. But if you're working at the prime end of the market, or you're focusing on central London offices, for example, that construction cost inflation is likely to be absorbed, whereas you're working towards maybe the kind of value add play, cheaper refurbishments to target a midpoint in the market, talking about offices, for example, that becomes more of a challenge. So cost inflation is slowing down. It looks like on the construction side, looks like somewhere 3 to 4% from should be over this year is the expectation, again from speaking to our experts. But again, it comes back down to asset management.
What are the dynamics like in terms of passing on costs to tenants? What sort of shape are tenants in general in terms of their willingness to absorb rent increases? And we hear constantly that rent is a small proportion of a company's overall overheads usually. How do they see that in the mix of the other costs they're dealing with?
Yes, certainly. I mean, I'll answer that by focusing perhaps on retail warehousing, because we thematically we think that's a really interesting sector. We were investing in that space as a house, and we did some work recently looking at the cost base of some of the big retail warehouse occupiers. And if you look at turnover, the property costs broadly averaged around 3% of the overall turnover, and about 5%, 6% of cost of sales. which is really interesting. And you look at that sector in particular, it's if you compare that against all sectors in the UK, it's got the lowest vacancy at the moment. It has the quite high footfall growth. It's stronger than it is pre-pandemic. It's in harmony, if you will, with online. It's got a lot of high proportion of discount retailers, essential retailers. So when occupiers that might be on the channel in terms of their offer or more skewed towards the physical formal stores, somewhere like retail warehousing, where you're paying for a lot of parks 10 to 20 pounds a square foot, buying parks a lot more than that, it's not proving too challenging. And to answer that question a little bit by talking about industrial as well, industrial, as you highlighted, has had this fantastic run over the last 10 years or so, and a lot of eyebrows are raised as to why. Part of that, I think, was over exuberance in yields, particularly last couple of years up to last summer. But a lot of it has been the rental growth, because what you had in that space was an affordability headroom. You can't increase rent unless there's that supply-demand dynamic, because otherwise, why would the tenant pay more when they can just move down the road? And for various reasons, which is a whole other discussion I can bore someone over the break with, is industrial missed its cycle. There was an oversupply in the wake of the GFC. But what we found over the last 10 years was that supply-demand tension, and really the cost base of occupiers for industrial. There's a big headroom. So we saw 50-60% growth in the regions. We saw almost 100% growth in London. And that wasn't occupiers paying scary rents that they couldn't sustain. That was really, it was the headroom that they grew into, and it's still a relatively stable part of the cost base.
That takes right as one point. I mean, the guys are absolutely right. It's key to actually have an operation that can work with our occupiers, and that relationship is key. But back to achieving returns, I mean, it really depends on what investors are looking for in terms of returns. Income is obviously the major driver, particularly of REITs, in terms of return. Capital values are cyclical and macro. And it's all about concentrating the micro. The micro part of our business and everybody's business is that we can control rent to a degree in terms of the actions that we take, the way in which we manage, the cost controls. So therefore, you can control income, you can't control capital values, because that's a macro event. And really achieving returns in the current environment when interest rate uncertainty is there, capital value uncertainty is there, has to be income focused.
That makes sense. We had an interesting chat before we came on, Stephen, around offices and definitions of prime and secondary. You were quibbling slightly with the way some in the media and elsewhere talk about the future of secondary offices.
Yeah, I mean, the market has always been, or the press and analysts have always been London centric and indeed prime centric, because there's big sexy buildings, £100 million in the city compared to £10 million in the regions isn't newsworthy. So there is that element. But if you break down the markets and understand the markets, there's roughly 1.4 billion square feet in the UK office market, of which 400 million is London and surrounds. The rest obviously being the regional markets in which regional REIT play. So roughly 1 billion square feet. The markets in London, 50% prime, 50% secondary. Super prime, depending who you speak to in London, 2-3% of the market. Regions, 16% prime. Very, very small element of prime. Super prime, less than 1%. But the super prime, in fairness, has seen the rental growth of that, there's no doubt. And that demand for the best building is there for two reasons, really. ESG is quoted as being the be-all and end-all. That's not the primary reason. Primary reason is all about retention and attraction of quality staff. Staff demand the best staff demand the best. Therefore, companies at that level have been paying increasing rents for the best space. And that's undoubtedly been a theme of the market. Can we get to a position where everything is super prime? If we can, it's going to be generations rather than short term. And actually, I look at our portfolio, which is regarded as secondary. Definition of prime and secondary in the UK market is broad. And that secondary space that we provide is good quality space in what I would regard as secondary towns and locations, rather than the space being secondary. And most of which is occupied by high quality companies. We're seeing rental growth. for the first time, obviously since the pandemic. Occupancy rates are increasing. And one of the key points in the office market, I saw a headline again, press are quick to jump on bandwagons, 100 million square feet of vacant space. So what, in a market of 1.4 billion, is that all vacant space that will ever be occupied again, or doesn't make feasible? It's not feasible to refurbish. No, it's not. And 35% of that's London. So that is an issue for London. The regional markets have been decreasing by 20 million square feet per year over the last 3 years. So space going out of the market and not being, these are net figures, not being replaced. So actually the 100 million square feet of vacant space doesn't worry me. It's a moment in time that will self-correct.
What are current leasing dynamics like in what we would call the secondary office market outside London? How would you describe the levels of demand, tension, and pricing?
Stronger, I think, than it has been in the last couple of years. I mean, regional REIT had its record year last year, 114 new deals, 5.9 million new income, by far and away a record year for us in terms of lease up. And that's probably, we're seeing that across most other competitors. They're seeing decent levels of demand. We're not back to inquiry levels or demand of the 2006s and 7s of this world, but we're definitely seeing an improvement, and I think that will continue. You asked earlier about passing on costs and rents. Most people are seeing rental growth. In our case, 9.7% this year so far, against previous rents. The big thing is the costs and the headwinds of costs. And unfortunately, in the office market, there's an awful lot of caps in terms of service charge. So that is an impact. So yes, we're seeing gross rent increases, but we've got headwinds in terms of costs. So the net gain is not as good as it could be. But I think as inflation begins to come under control, and we all hope it will, hope rather than expect, I think most analysts are expecting it to come back down, then that will change.
I'd like to hear the panel's views on financing costs and where they're going, where the cost of money is going to go. Jeff?
Yeah, happy to. I mean, we as I touched on, we're a modest user of leverage, but notwithstanding that, there is question marks around availability of debt, and I think banks are very much more discerning as not only the type of product they're lending on, but also the counterparty that they're lending to. And I think we're going to see a lot more question marks around that. We're at the early stage of that. We did a refinancing the end of last year for 2 office buildings in Germany, linked together. One was in Hamburg, one was in Stuttgart. We had 7 banks that were willing to lend, and we were able to achieve a margin of 85 basis points. Now, that's a gearing level of around 40%. So that's a pretty phenomenal low margin. I'm not suggesting that everyone could probably achieve that. I think probably the needle has moved a little bit more over the last sort of 3 months in terms of the way banks are pricing that. But for good counterparties, good assets, there definitely is availability of debt, certainly at that sort of LTV as well. If you're out there trying to find higher levels of gearing, I think you're going to get a shock. I think that's the point that you touched on, where we may see a little bit more distress around that and more equity needed. And obviously the cost of equity is much higher than debt. So that will may even see sort of more assets that are hitting the market to try and sort of cover and for that refinancing risk. I think in terms of banks at the moment favouring certain asset classes, I think certainly logistics and bigger logistics is probably easier to finance today rather than say smaller industrial assets. I think banks are very much thinking, given how much choice they have, they're going to lend on things that don't really have any hairs on them. So they're less likely to take on sort of items that they would have dealt with, say, 3, 4, 5 years ago. Now it has to be a pretty clean deal. And hence that's why the alternative lenders may be looking at some of that other products that the banks are sort of walking away from, and obviously the cost of that is increasing. So I think from my perspective, at lower LTVs, there's plenty of debt. We're a strong counterparty. We've got the ability to de-risk assets around that sustainability that we've talked about. But there certainly is pressures on different sort of subsectors that are going to create some distress.
I'd be interested to hear your take, given your portfolio footprint. Do you see differences around Europe, different countries? Do you see different dynamics around?
Yeah, definitely. And I know offices we've sort of been talking about, and I spend a lot of time with investors on this comment as well. And I've got 3 office assets in my portfolio. One of them in particular I'd like to talk about is in Stuttgart, where Stuttgart's probably got the lowest level of vacancy in the whole of Europe at about 1.5%. So there's just no choice for occupiers to go anywhere. The building we have is a grade C building. We need to improve the quality of that, but we're coming off rents that are 15 euros per square metre. Now, to put that into perspective, that's 15 euros per square metre per month. To put that into perspective, relative to prime, which is at around 33, there's a huge discount there. So we have the ability to improve the quality of that, but equally increase the rents accordingly and help pay for that capital investment. And that's something that we've done, and part of our whole acquisition strategy, and many managers and owners do this, but about looking at affordability and making sure that you're coming from a base that actually you can work with, whether that be keeping it in an office or actually looking at alternate use, which some of these buildings will need to go through. So Stuttgart's probably one end of the spectrum. Paris, in terms of, thankfully we have no exposure to La Défense, but we're starting to see vacancy rates there shooting up to sort of record high levels. I think there's going to be issues there, and probably similar to where sort of potentially Canary Wharf and some of the struggles that's going to be facing. We've tended to sort of stay away from the sort of office submarkets and really focused on being in sort of areas where there is demands for mixed uses and coming off that rent affordability. So that's just on the offices. Obviously, being a diversified investor, looking at all other asset classes as well. Logistics, we still think there's sort of stronger play on the continent for that, particularly given where we are with sort of e-commerce and penetration rates still relatively low levels, and rents on the continent relative to where the UK has got to is still very, very modest. So that's a sector that we're favouring, and about a third exposure in that, and see stronger rental growth. And then retail, we talked the other day. I mean, you can't look at retail with one brush. It's so disparate. We could probably talk all day on the positives and negatives of that sector.
Yeah, maybe not all day, but I would be keen for the panel's views on retail, and given where valuations have gone even before COVID and then exacerbated by COVID. I'd like to hear.
Debt on retail is a big issue. Debt on retail is hard to find. Retail warehouse being an exception. But just on the debt element, and I think Jeff's absolutely right. The lenders are very, very keen now to understand in far more depth business plans and work with the operating companies such as Schroders or regional REIT. So I think the manager has become more important than ever in terms of debt. The other thing, of course, is that with lending at typically 35 to 50% LTV on arguably a low LTV, it's a very low risk lending environment. If you're a bank out there, and I think what you're seeing with the competition between the banks and other alternative funders, I think we'll see margins actually decrease. Your base rate's up, obviously, but as competition comes into the market, there's not a direct pass on of margin to the market. And we've seen this before. This isn't new. As more competition comes into the debt market, people are prepared to shave slightly the margin. So there's not a direct correlation again to actual cost of borrowing compared to interest rate movements.
How would the panel view retail and the various subsectors within it? How would you compare, say, regional shopping centres with out of town retail parks?
If I kick off on that one, I mean, I've touched upon retail parks a second ago, and I will actually tie in a comment on debt in that. With a lot of the transactions we've seen at the start of the year for the bigger part, 30-40 million plus, there's a handful of buyers out there. You can identify the British Land, Columbia Threadneedle, different part of the business, Realty, and none of them have been particularly debt backed. So I think it's really interesting that at the minute, the banks and lenders are kind of finding their feet a bit in terms of the current environment, but they will return. And part of the reason they will return, and to answer the question, Oliver, is that I touched upon vacancy rate for retail warehousing. It's less than 5% nationally. So when you think of the broad spectrum of quality, whether you're buying somewhere in the northeast or somewhere in the southwest, southeast, you're probably going to have quite a solid income stream. And when you look at vacancies generally, and when obviously lenders are looking at retail, particularly retail warehousing or strong sectors, if you go back to the financial crisis and you look at all property, if you took a straw poll as to where vacancy rates got to across all property, I'm guessing I'd say people would say somewhere between 20, 30, maybe up to 40%, and it reached about 11% nationally. And coincidentally, we're about 10%, just over 10% at the moment. Now, obviously, all markets are different. Property, as you highlighted earlier, we've highlighted, is more nuanced than ever, more complicated than ever. But the point being is that and Stephen touched on this, when you go beyond the headlines, the actual reality is a little more boring and a little bit more stable. So when looking at, say, retail warehousing, I've touched upon that. It's at the yields that they're at, prime yields at late 5s, 6%, and if you go up the risk curve a little, then you're up in the 6s and 7s. On a long-term basis, that's relatively attractive. But then, again, to answer your question, if you compare that to high street and shopping centres, shopping centres have taken an absolute bloodbath in terms of valuations, but it's been over a long period of time. It needed to happen. The struggle with shopping centres on high street is too many units. If you could have a magic wand and suddenly your shopping centre is half the size and your high street is half the size, you probably have all those units occupied, because if you go to small regional high streets, places you've probably never heard of, or somewhere like Manchester and London, the footfall is still pretty strong. It's just a case of rebasing rents and right-sizing units and repurposing units as well. But all of that takes years. It always does. Landlords will resist falls in rents until they absolutely have to, just what we do. And it takes time for other players to come in and take space. Seeing that with the department stores in Oxford Street, for example, and that's got an identity crisis, but it will get there. So there's still a lot of risk in that space, but retail also is that kind of sector. If you take a photo of one high street and take a photo in 5-year increments going back 30 years, the lineup will be very different. So that's nothing new to that space, but it's still there's still a degree of rebasing on the high street and shopping centres. So still quite a high risk area.
Yeah, I think the difficulty, and you probably hear later today from sort of other shopping centre owners in particular, that thankfully as a house we've steered away from that. But I've come from a shopping centre background, being at Westfield and Lend-Lease in my earlier days, and the sector is completely difficult to price today in terms of trying to get an understanding of, well, what is a sustainable rent? So what can a occupier pay so they can make some profit? And it may well be because we've got service charges increasing and out of control, that actually your net rent is zero. So capitalising zero, there's your answer. And that's probably a comment more for secondary assets, and this whole point about looking at alternate use and repurposing. And you made a comment about sort of blue water, and that's probably a prime example. It may well be that those centres are sort of outperform and where retailers can afford to pay, and they're doing sort of extraordinary levels of turnover, and therefore their fixed costs are more than covered and can afford to pay a decent rent. But I think for those centres that are in secondary locations, we definitely haven't seen the bottom still.
I would echo that with Jeff's comment. I mean, shopping centres are expensive to run. You have to pass that on if you can to the tenant. Increasingly difficult. We've shied away, obviously, from retail in our fund. We're a specialist office fund. But the other aspect I would say in retail over the last few years is very few new entrants to physical retail. You are seeing now, I mean, if you're going to start a retail business today, you'd probably start as an internet-only business or multi-channel. There's certainly focus towards online sales, and then you may well come into physical retail thereafter. You've seen that happening a couple of times, but there's not a lot of new retailers being created to then take physical space, unlike the industrial sector, unlike the office sector, where there are new entrants all the time. People come with new ideas all the time. I just don't see where that demand for physical space is coming from.
I mean, we do like, just on retail, we do like certain pockets of retail in terms of grocery anchored and led and sort of urban centres where you're sort of dealing with local conurbations and sort of standalone DIY. That type of retail has sort of blossomed during the pandemic and been a beneficiary as more people have invested domestically. They've been the winners. So that's sort of where we've had some success.
I agree with Stephen's comment in terms of there's not a huge amount of new entrants into the retail space, but what we have seen, again, coming back to retail warehousing, is that you've seen a lot of the discount retailers expand at quite steady rates, and they've been the main taking the main responsibility for taking up space, and likes of the range and B&M, Lidl and Aldi, which is everyone hears about quite a lot. So they've absorbed a lot of that space where you have that kind of conveyor belt of CVAs and administrations in 2018, 2019. What we saw is although rents were generally rebased, that space did get absorbed relatively steadily.
Thank you very much. I'm aware there may be some questions from the audience, so I'll ask. Let's see if we have anyone who'd like to throw something at our panel. Who would like to, gentlemen up? I'm sorry. You go.
Thank you. Push it once. Yeah. What do you think the future of retail is? You've talked about all the trends, and I like the thinking. Where do you think it might go? What is, I mean, multi-purpose or change of usage, you've mentioned, but there's got to be something new coming up. I see that.
As you're looking at me, I'll answer first. I mean, for one, real estate markets always evolve. There's this kind of sometimes there's a propensity to think, they're static, and then there's some shock like COVID, and suddenly things have changed. They always evolve. They always reinvent themselves, and retail's obviously no different. What we've seen is a, and I'm speaking very broadly here, but what we've seen is a propensity for more experience-led retail. Obviously, leisure occupiers and the way they're funded and run obviously carry a degree of risk, but people like experiences. So that's part of if it's coming to repurposing shopping centres or town centres, then very experience-led. It's about the more independence as well. So that obviously comes to a pricing question because of the underwrite, but you see a broader range, a longer tail of occupiers in that space. In terms of the online, I mean, again, online has been if you look at the chart of growth of online sales, all UK sales, it's remarkably steady. It's 1 to 2% every year, apart from 2020, since 2008. It didn't jump up 1 year in 2017-18. It's been gradually eating away. It's about 25% of all retail sales now, approaching 30, and that'll probably grow. But it is worth highlighting that about half of all online sales are the top 20% of earners, and the lower earning groups as well, and more the sort of discount retailers, etc. They occupy about half of retail warehousing, as I highlighted earlier. There's essential retail as well, pet stores and shoe shops, things that don't lend themselves as well to online. Halfords, for example. They do work online, but there is still a demand for physical stores to go in and try bikes, for example. So there is a stickiness to a lot of those type of essential retailers as well. And I think, again, retail warehouses, if you jump back 10 years, you'll see bulky goods and fashion. Now you'll see a much broader range. You'll probably see GPs and health consultants. You see gyms, coffee shops. So it's far broader. And the high street is probably similar in its own way. Shopping centres, much more leisure, far broader, smaller as well, and probably a lot more conversion to residential. But that hasn't happened as quickly as we would have thought. I think I saw a stat recently, 1 to 2% of shopping centres have had repurposing for residents so far. We talked about the costs earlier. That's been the big hurdle. At some point, there should be opportunities, but it's going to take years for that to play through. But there is, we haven't touched on it, we focus on commercial, but there is a housing crisis and a shortfall in the new supply of housing, and that will play a big role.
Thank you.
Jeff or Steve, would you like to come in on that point?
Jeff touched on it earlier. I think there are pockets, essential retailing, opticians, chemists, supermarkets are all essential services. Interestingly, Matt commented on internet penetration. It did reach over 34% in the pandemic. It has fallen back, obviously, since then, and it stands present on the towers at 26%. There will be a level of saturation. I'm not sure it will continue to grow. I think there is a level for that very reason that it tends to be ABC populations are buying more on the internet. So I think there will be a saturation point, and nearly all retailers are going multi-channel. So there will always be a demand for physical retail space. I'm just not sure what that demand looks like. And I've been often quoted as saying, I don't invest in things I don't understand. I don't understand where retail is just that.
Well, what I can say is that obviously it's so complex, but the value of a good asset manager in retail has just gone up extraordinarily, and how you look at what do you do? Because they are so complex. What do you do with these secondary, particularly secondary assets, about repositioning them? One of the areas that we have been looking at is obviously more that linking of grocery and resi, and then having 3 or 4 specialties that works in very strong urban locations, and that's it. That feels pretty safe and manageable. And thankfully, we focus on that side rather than looking at bigger, questionable shopping centres.
Very wise. We had a question, the gentleman over there.
Microphone. Given sort of the current relative high interest rate environment, how are you guys looking at acquisitions? Are you having to move up the yield curve in order to be able to get the levels of returns that you guys require then to pay out?
I just did a little logistics asset in the Netherlands, actually, and I mean, all investment managers are either pausing or sort of stepping back and trying to assess the headwinds that we're all facing. But the reason we sort of had conviction to do that investment was it was a 20-year lease, very strong covenant, highly sustainable building. We were able to buy that off a 5.6 net initial yield. Now, with where debt is in Europe, debt's still accretive to that sort of yield profile, so it makes sense. There is other investments that I have withdrawn from in terms of being slightly keener than that. So I think certainly at the moment, still trying to price the different risks and where rates will level out. And I mean, if you look at the 5-year swap rate, it's been, I mean, 6 weeks ago it was at 3.5%. Today's at 2.8. This is 5-year swap for Europe. So it's highly volatile. So it is having an impact on how we're assessing our returns. And I think as a investment manager that can look across different countries and different sectors, there's opportunities, but it needs to be certainly upper 5s for it to be accretive. Also, in terms of what we're trying to distribute to investors as well, obviously being an investment trust, being income focused. But it was sort of a comment you made, Ollie, about that investment trusts have focused on sort of income and actually through that had to buy some slightly ropier assets. But actually, we still can buy some decent investments to deliver that return, and that logistics asset is a good example.
Depends on your business plan. I mean, we've always bought higher yielding assets with a view to improving them, and obviously as you improve those assets, values come in, therefore you see yield compression. So we've always done that. In terms of right now, we're simply recycling. So we're selling assets for alternative use, normally lower income assets, and then recycling into income and higher quality assets. So there's definitely an opportunity to buy higher quality assets, just given pricing. But yields are high in my sector. So again, luckily our debt is fixed, so 3.5% for the next 5 years. So we can still utilise that accretively.
Similar to Stephen, fixed cost of debt 3.36 until the end of 2026. So it gives us a bit of protection. There has been some caution on reinvestment at the moment for obvious reasons. We're also getting quite a nice rate of return on our cash, and there's some cash that sits in the fund. So although we see, as been touched upon, been some correction in values and some stable values. So arguably, you could have said best value was in the early part of the year when you could have picked up assets at the cheapest point in the cycle. Maybe we still think that there should be decent value for good assets. In the latter part of the year, we don't see values jumping up suddenly. So there has been a degree of caution. But like I say, with the rate of interest we're getting on our fixed cost of debt, there's been little pressure.
I think those are low rate fixed debt, but are you able to help with the next purchaser probably borrowing at a much higher level? You guys can step up. You're not really looking at what the effect is, just looking at opportunities. So
I think I focus on the real estate really. I mean, we're not bidding for this fund, but we are on others, and ultimately it comes down to what we see the value of the asset. Our competitors would likely be cash only anyway. I touched upon the bigger lot sizes that we don't fish in, but all those buyers are cash at the moment, and that's the trend in the market. So no, it comes down to fundamentally we think that the value, the asset is valued, and there are enough cash buyers out there to kind of a normal competitive market.
It depends on the sector. There's very few buyers in the warehouse sector at all, so there's not that much competition for you guys. realty are obviously the biggest in that sector just now. And they're buying all cash for the simple reason that there's no arbitrage advantage to debt just now. And they've got very deep pockets. In my market, there's relative transactions. So again, very few buyers. If we if we could raise a pile of cash, we could deploy it very well. But unfortunately, as Ollie pointed earlier, REITs are trading such a discount. That's not going to be possible in the short term.
Who else would like to ask a question?
I've got some online questions.
Gentleman in the corner there. We'll get time there.
What are your expectations for interest rates in the medium term and in the long term?
Crystal balls. Who would like to have a go at that?
I think
Channel lenders to make
take on sort of Europe, but I think we're expecting another small increase and then things leveling out. I mean, if you look at the curve of sort of swap rates, it is today, I guess, as touched on before, about 2.8. Longer end is coming down to circa 2.6, 2.7. So it gives you some indication. So yeah, I think getting inflation under control, and I don't think a lot of the forecasters saying that's probably not going to get back to 2%, which is really the target for Europe, but certainly somewhere around 3. I did see a graph the other day that where you've had inflation above, I think it was above 3% for a certain duration. It takes you 10 years to actually get it back to sort of that 2 to 3% level. So I think we're in for a period of much longer inflation, and therefore rates being slightly higher for a bit longer than expected.
I think we all look at yield curves on a weekly basis these days, just to see. I mean, it all depends when you have to refinance. Yeah, as a forever player, as we all are, all you're really focused on is when you have to refinance. And for us, for most of us, we've been sensible enough to lock into longer term fixed debt. So our concerns will be 27, 28. Where will yields be? The yield curve shows there, and changes on a weekly basis, as Ollie pointed out earlier.
Matt, any observations or predictions?
I was going to say sort of a slightly washy version of what has already been said in terms of I think it would be misguided. I think to expect interest rates to come down optimistically over the course of this year into next. I think it's likely they're going to be stubborn for longer, which is a variation of what.
And what that's likely to do is mean that pricing won't recover dramatically in most sectors either. Back to Matt's point, he's buying up producer later this year, and I'm sure that'll be right. If interest rates stay stubbornly high, then we are in a situation where we're not going to see massive capital growth. So back to the income story, that's what REITs really all about.
Where this gentleman in the blue over here.
Yeah, I've got some of the online questions have come in. Do you have any impending debt expiries, and what conversations have you had with banks and lenders?
I just touched on a refinancing that we did where we had sort of 6 lenders in Germany. So there is definitely a pool for good real estate. We've got some debt expiring later in this year on some industrial assets in the Netherlands. Again, I think some healthy discussions with lenders around that. I mean, I think the question is probably more around offices in terms of refinancing. That's probably the area where I'm getting sort of a little bit more concerned around. But in terms of good logistics, grocery retail, standalone retail, I think there is definitely debt available for that at competitive terms.
Stephen and Matt, any observations?
Yeah, I think Matt's in the same position we are. We don't have any immediate definite refinancing. So as I say, we're looking towards where rates will be in 3, 4, 5 years' time.
Do we have any more questions coming through? This gentleman here.
Working. Hi. A couple of questions, if I may, please. We've seen a couple of bids in the sector, as you've said, including industrial REIT, which as a shareholder I've got kind of mixed feelings about. Do you see a lot more bids coming in, given the fact that just about everything is on big discounts now? That's one question. And secondly, just on offices, just going back between kind of super prime and kind of tertiary secondary properties. As investors, obviously, we've got a huge number of choices. Do you think that we should look beyond super prime, say for instance something like Helicorp, where you've got, as you said, strong demand still in that space. And is there really any value in tertiary?
Tertiary, no. Tertiary will undoubtedly be converted to alternative uses in due course. I think the occupier market is quite interesting, and we haven't spent a lot of time in the occupier market because we obviously got a limited amount of time. But if you look at demand and what people want, it's all about the environmental small feel, and that's all to do with keeping employees happy. And we talked a little bit about rates in terms of costs. I mean, the average, the studies we've done, the average proportion of costs in terms of your occupational costs against the total cost of businesses is 6%. So we spend an awful lot of time trying to focus on 6% costs. All your costs are people, and therefore you've got to keep people happy, and it's all about the environment you're creating for people. But so I look at the super prime in two ways, as mentioned earlier. Was it to retain, attract staff, or was it for ESG reasons, or a combination of both? I believe it's a combination of both. There's certainly a focus on staff, and as labour markets free up, perhaps that becomes less important. But that's an argument that people will have. But if the super prime is indeed the nirvana, everybody wants super prime, which I don't believe they do. I don't believe they want to pay for it. I don't believe most companies need it. But if that's the nirvana and we can't get there in the short term, which we can't, build costs certainly regions are not there to or rents aren't there to sustain build costs, then what do companies do? They come up for renewal, they need more space or less space, they take the next best. And I think often that's where the growth will come. In grade A, high quality space, not necessarily super prime. The guys talked about your rental difference, and in Germany, UK is the same. Super prime has gone to 40, 45 pounds in most regions. Very good grade A space is still languishing in the high teens, early 20s. That's the biggest gap we've ever seen. Just down to a lack of supply of that super prime. So certain companies are prepared to pay more for that. So I think that's where I see the growth and the performance in the office market. So that's the one aspect. The second question I'll have for people to deal with.
Yeah, take everybody. Everyone would like to know where this one's going to come. Jeff and Matt, do you have any views on sectors, sizes, corporates?
Well, I mean, I'm fairly unique. I'm the only UK listed vehicle that invests on the continent, so having a diversified portfolio. So I have no other sort of peer, which is positive and negative, because we think about sort of M&A activity. There's not a natural sort of fit, but yeah, look, I'm sure the likes of Blackstone, in terms of what the capital they've raised, they're actively looking at other vehicles as we speak, given the attractive discount.
We have time for probably two more questions. Who would like to go?
Yeah, Oliver, can I actually ask one to you about the residential market? We've recently seen the government introduce this rent reform bill. It's pretty, it's good for tenants. What's the risk if we get a Labour government in, say, the next 18 months, that they introduce rent controls in the private rental sector? So, what are your political sources telling you about appetite for rent control, please?
It's an interesting question. I was in Scotland a couple of weeks ago, and obviously they've experimented
Currently
pretty poorly with rent controls there, and the general economic mood up there is very grim around a whole range of things. That's definitely one of them. I mean, it's my view they don't work. They're sort of classic statist intervention that distorts markets. Ed Miliband was a proponent, wasn't he, of rent controls when he ran against David Cameron in 2015, and he's an influential member of the shadow cabinet, but I don't think it's on the agenda from what I hear. I think there are bigger fish to fry elsewhere, and I think the current Labour shadow cabinet is much more centrist and sensible than previous ones have been, and I think they understand that supply is ultimately the answer to housing crisis rather than top-down controls. That's my personal take.
And the Scottish experiment hasn't worked. Rents have increased at a faster rate than ever as more and more properties go out of the market, as private landlords decide to sell assets rather than continue
So it hasn't worked. I think Labour have accepted that.
Any more questions? This gentleman.
We haven't touched on AI. Is there any scope to leverage off that? I mean, obviously, data centers, that's not directly connected to it, AI, but a part of it. What's your view on AI and the opportunities, 5G, and densification of networks and all that?
It's a big question to end on.
It is, isn't it? I mean, I've got a data center in my fund in the Netherlands, and it's a really topical point because licenses for that particular use has stopped. Access to power is a big concern, and how do you sort of make these more sustainable? So it's something that we are trying to deal with, and that doesn't deal with your AI question specifically because that's I'm not experienced or an expert to touch on that because that's affecting so many different parts of not only industries but whether it be asset management industry as well. But yeah, certainly data centers becoming much more increasingly a need to deal with a very small part of AI. But that sits in our alternatives bucket. But I mean, I don't know whether anyone else has thought about AI and how it's affecting your management of assets. We're probably at the infancy of thinking through it.
Yeah, it's a massive area. It's a really interesting area. I think what it comes down to a lot for the occupiers is cost. It's about cost efficiencies. And you know, if you look at the industrial space, for example, there are limitations to where occupiers can go because it's about the labour pool. So if they're moving towards AI and automation, which is a massive area, and they need less people at a location, that gives more flexibility in terms of locations. That makes kind of picking locations much more easier and more granular. And obviously that's at a very high level. And then there are question marks. You know, we've seen AI with retail already, you know, with self-checkouts, for example, to a certain extent, and that's only going to increase. So ultimately, you know, we've commented, Steve and I both commented on cost base for occupiers. The reason why you move into this area is cost efficiency. So it's interesting in terms of what that means for affordability for physical premises.
And I guess my only comment on AI is it depends on its impact on employment. Does AI replace employment? Well, as we've seen technological advances over the years, new jobs get created. So it's all about employment levels. There's clearly a correlation between people in jobs and demand for physical space. So if AI was to, for example, wipe out 20% of jobs, that's an issue for all of us. But I don't know. I mean, I do follow the American hearings. I think I quite closely just now. That's very, very interesting. So there may well be curbs to AI in due course.
My dad did ask ChatGPT to write my React article for me, and it was worryingly good. So keeps on our tiptoes. We're sadly out of time. Thank you very much for your questions, and please say thank you to our panel for their insights.